So welcome for this session. This is Safari. Now today I want us to discuss, we'll do some Brock's revision on partnership, that's conversion of partnership into a limited company. So open with me November 2019. November 2019, question 1B. November 2019, question 1B. So we can be able to do part A. Part A of the question, part 1 is distinguish between adjusting and adjusting events. We see that adjusting events are events after the reporting period but before the AGM that provide more evidence of the circumstances that happen before within that period. Then an adjusting events, they are those events that occur after that, showing no additional events. Then number 2, describe the accounting treatment of event after reporting period. Adjusting events, we say that they require amendment to the financial statement, but for the non-adjusting events, they need not to be adjusted to the financial statement. You only need to show the disclosures. Good. Part B of the question. Chanda, Pete, and Teda have been partners in a business for many years, sharing profit and losses in the ratio of 2:1 respectively. On 30th of June 2019, the partners agreed to convert their business into that of limited liability company to be named Chapete Limited. The trial balance extracted from the record of the partnership as at 30th of June 2019 was as follows. So you're given the statement of financial, you are given that trial balance. We have property at cost, building is 50, plant and equipment at cost, motor vehicle, furnitures. Provision for depreciation, 1st of July 2018, that's at the beginning of the financial year. Net profit for the year, trade receivable and trade payable. We have inventory, cash and bank balances. We have the fixed capital account, bank loan current account. Then we have the drawings. Additional information. The PPE in the partnership were being depreciated as follows. Then we are told that depreciation for the year ended 30th of June 2019 has not yet been provided for. So we need to provide for depreciation charge for the year. So number 1, we have on building. Then we have on plant and equipment. Then we have on motor vehicles. And then we have furnitures and fixtures. Building is at the rate of 2% straighten. Here we have is 12.5%. Motor vehicle we have is 20%. Furnitures and fixtures is 10%. Building is 2% straighten. How much is the cost of the building? Now for the cost of building, we have property, of which property is run at building, of which we are told that building is 50 million. So it's 2% of 50 million. Then plant is 12.5 on a reducing balance. So plant and equipment is on a reducing balance. So plant and equipment, the cost is 25,000. You minus the accumulated depreciation. Accumulated depreciation on plant and equipment is 13,000. So in short, reducing balance, you depreciate based on the net book value. Then for the motor vehicle, is 20% straighten. Motor vehicle straighten, that means on cost. That's 12,000. Then furnitures and fixtures is 10% straighten, of which here we have it's 4,000. So we need to get the depreciation. So how much is that? So 0.02 or 50,000. You got is 1,000. 25 minus 13 times 0.125. 1,500. 20%, that's 2,400. 10%, that's 400. So how much is the total depreciation? 1, 2, 3, 4. That's 40. That's 51, right? So 2,500. You add 2,800. You get 5,300. That's the total depreciation charge for the year. Then that was note number 1. Note number 2. The partners were entitled to an interest on fixed capital balance at the rate of 10% per annum. No salaries were paid to the partners. So we have the interest on capital. And for the interest on capital, we have Chanda, Pete, and Tenda. It's 10% on their fixed capital. So how much was the fixed capital? For the fixed capital account charter is 30,000, 20,000, 10,000. That's I figured though in thousands. So this is 3,000, 2,000, 1,000. So we have a total of 6,000 as the interest on capital. Number 3, the tangible and current assets were to be transferred to the new company at their fair values as follows. Number 4, the current asset and their liabilities were to be taken over by the new company at their book values. Number 5, the purchase consideration amounted to 110 million and was settled by the new company through the issue of ordinary shares of shillings 10 each to the partners in satisfaction of the amount due to them upon conversion. Required. Number 1, realization account as at 30th of June 2019. Realization account. How do we prepare realization account? So number 1 is realization account. So we say that realization account, you debit all assets at their net book value. All assets at their net book value. So for the assets we have property, we have plant and equipment, we also have the motor vehicles, we have furnitures and fittings. Those are non-current assets. Now for example, for the property will take 60,000. We want its assets at net book value. You raise the accumulated depreciation on building was 5,000 minus depreciation charge for the year, which is 1,000. For the plant, you will take 25,000. You raise the accumulated depreciation of 13,000. Then you raise depreciation charge for the year, which is 1,500. A motor vehicle, the cost was 12,000. You raise accumulated depreciation, which is 4,800. Then you raise depreciation charge for the year, which is 2,400. Fixtures and fittings, 4,000. You minus the accumulated depreciation was 1,600. Then you deduct 400. That's the charge for the year. So what do you get? So 60 minus, that's 54,000. Here you have an amount of 10,500. We'll have 4,800. Here we have 2,000. But we say that it's all assets at net book value. So any other assets? Yeah. We also have trade receivable. Trade receivable as per the trial balance, it's an amount of 18,200. Then you also have inventory. Inventory is part of assets, an amount of 25,300. And then we have cash and bank balance. For the cash and bank balance is an amount of 81,20. So debit all the assets at net book value. Then you credit the current liabilities. And for the current liability, number 1, you have trade payables. And trade payables, we have an amount of 14,700. Any other liability? Yes, you also have the bank loan. You also have the bank loan, and the amount of bank loan is an amount of 18. Now, if you take the assets minus liability, you get what you call the net asset. Now, you compare the net asset against the amount they were paid on conversion, and that amount they were paid is what we call the purchase consideration. And our purchase consideration you were given in the last note. Let's go to the last note. The purchase consideration amounted to 110 million. So they were paid 110 million. Now the question is, did we realize those assets at a gain or at a loss? So the credit side is more. So if the credit side is more, that means what they were paid was more than the asset value. That means they realized the assets at a gain. If the assets were more than what they were paid, that means they realized at a loss. So and the total we have is 142,700. 142,700. Then you raise the assets so that you get the amount of the realization gain. And you get a realization gain of 19,780. So realization gain of 19,780. Then this is a partnership. So since they realize that again, they need to share that gain. How are they sharing profit and losses? How are they sharing profit and losses? You are told that the first paragraph. Chanda, Pete, and Teda have been partners in business for many years, sharing profit and losses in the ratio of 2:2:1. So Chanda, Pete, and Tenda, 2:2:1. You divide by total, which is 5. So it's 2/5. Then the gain was 19,780, 19,780, 19,780. So here you have 7912, 7912. Then we have 3956, 3956. Good. So that's how you answer part 1. Part 1 required you prepare realization account. Number 2 is the partner's capital account. We prepare the partner's capital account. So number 2, how do we prepare the partner's capital account? So you have 3 partners. Chanda, Pete, and Tenda. Chanda, Pete, and Tenda. So on the credit side, we say that you factor in the capital balance brought down. So how much was the capital? The fixed capital. Chanda was 30,000, Pete 20,000, Tenda 10,000. Also, you have the current account. For the current account, Chanda you have 4280, Pete you have that 560, Tenda we have 2340. Then from a realization account we had a realization gain. You debit, you credit. So realization gain. So 7912. 7912. Then we have that 956. Then the partners were entitled to capital, interest on capital. Now interest on capital will increase the value of the current account. You can also include it as a separate item. So interest on capital. Here it is. The interest on capital Chanda was 3,000. Pete 2,000, Tenda 1,000. What else? Drawings reduces their claim. So drawings, we say that you debit on the partner's capital account. We had drawings. So in the trial balance, we are given the drawings. Chanda was an amount of 1,580. Pete 1,170. Tenda 710. Then, by the date of conversion, they had already made a profit. So, in case it's a loss, you credit. In case it's a profit, it will add the value of their capital. So, we had profit. How much was the profit? So, now let's go back to the trial balance. Go back to the trial balance. We determine the amount of adjusted profit. Now, in our trial balance, we had the net profit. How much was the net profit? The net profit for the year to 30th of June 2019 was an amount of 28,800. 28,800. That was the net profit at the end of that period. But this was a profit before taking into consideration the depreciation as well as the interest on capital. So you raise number 1, depreciation, and the total depreciation we have is 5,300. Also, there was interest on capital. At the interest on capital, the total was 6,000. So, how much is the value of the adjusted profit? So, it's 28,800. You minus 53, you minus 6,000, get an amount of 17,500. So, now that's the adjusted profit. Then we share profit share. For the profit share, we have Chanda, Pete, and Tenda. They are sharing the ratio of 2:2:1. So it will be 2/5, 2/5, 1 over 5, 17,500, 17,500, 17,500. So here you have 7,000, 7,000, 3,500. Good. So profit share we have 7,000, 7,000, 3,500. So how much is that? So you add the total for each. Chanda, the total is 52, 192. Peta we have it's 40, 472. Tender we have is 20, 796. Then how was this amount paid? How was this amount paid? So now I want us to balance this account. And you see that the partner's capital account should always balance because we are closing off the books. Chanda, the total is 52, 192. Here we have it's 40, 472. Here we have 20, 796. So now you want to determine the balancing figure. You take the total minus the drawings. So how much will be the balancing figure? For example, for Chanda, 52, 192, and that's the total of that. You minus 1580, we get the balancing figure. And the balancing figure will be an amount of 50, 612. Total will be that 9, 302. And then tender with amount of 20, 086. And what is that? Can you add the total of the balancing figure? Add the total of the balancing figure. Add the total of the balancing figure. Now the total is giving you is 110. Now what is that? Now let's go back to note number 5. Let's go to note number 5. The purchase consideration amounted to 110 million and was settled by the new company through the issue of ordinary shares of shillings 10 each in partners to the partners in satisfaction on the amount due to them upon conversion. You see now the balancing figure, that was the amount due to the partners at the date of conversion, which was settled through the issue of ordinary shares. So this is ordinary shares, of which the total is 110. Good. So that's how you prepare the partner's capital account. Good. Lastly, we have to prepare the opening statement of financial position as at 1st of July 2019 for Chapete Limited. Opening statement of financial position. So how do we prepare the balance sheet? How do we prepare the balance sheet? Now to prepare the statement of financial position, so I want to grab one of the items there so that we can present the balance sheet. So let me just grab adjusted profit. Yeah, so just let me wrap this. Number 3 is the adjusted statement, a statement of financial position of the company. That's Chapete Limited. Chapete Limited represent statement of financial position. Yeah, as at 1st of July 2019. That was after the conversion. Now, in this case, you only take into consideration the assets taken over by the new company. So, we start with assets. For the assets, we have the non-current assets. You don't take the assets in the trial balance. You take the assets which were taken. So, can we go to note number 3? Let's go to note number 3. Note number 3, we are told that the tangible and current assets were to be transferred to the new company at their fair values as follows. So, you are given that property at 57 million, but shillings are in thousand. Then we have planted equipment. For the planted equipment, 16,000. Then we also have motor vehicle. Motor vehicle was an amount of 9,500. Then we have fixtures and fittings. It's taken at 35. Then Under the non-current asset, we'll have to factor in what we call the goodwill. Remember I said that the difference between the purchase consideration and the net asset acquired, the difference between the two gives rise to what we call the goodwill. So we'll come back to that to determine goodwill. So let's go to the current assets. Now for the current assets, you are given that one in note number 4. The current assets, number 4 you told that. The current assets and the liability were taken by the new company at their book values. So you took the assets and the liability, the current asset and liability at their book value. So you take the way they are in their trial balance. So we had inventory. Our inventory value was 25,300. We also had account receivable. Trade receivable is an amount of 18,200. And also we had cash at bank, which was an amount of 81,20. We get the total assets. Then we go to equity and liabilities. Now to our equity and liabilities, number 1 we have ordinary share capital. And ordinary share capital, remember they were given shares. The purchase consideration was 110, which was allotted through the issue of shares. So that means we issued shares worth 110 million. Then we go to the liabilities. Under liabilities, remember I told that the current assets and liability were taken at their book value. For the liabilities, we had to trade payable and the bank loan. So we take trade payable. Also we have bank loan. Trade payable, it's an amount of 14,700. And then bank loan, we have it an amount of 18. It's an amount of 18. And the total equity and liability is 142,700. Now for the assets, we have not yet computed goodwill. And we see that the goodwill is the difference between. So let's work for goodwill. How do we get goodwill? Goodwill is the difference between the purchase consideration you raise the net asset acquired. The purchase consideration was 110. You raise net asset. How do you get the net asset? It's assets minus liability. So you raise net assets acquired. For the net asset acquired, you take the assets taken over. You raise liabilities taken over. That's how you get the net assets. Now for the assets taken over, just do this. Add all these assets. 57, 16, 95, 35. So let's just add. So you take 57,000, 16,000, 9,500, 3,500. Then they also took over current assets, of which we had 25,300. You had 18,200. Then you had 81,20. Now the total assets taken over was an amount of 137,620. Then you raise the liabilities. Here are the liabilities. The liabilities were taken at book value. Trade payable, it's 14,700. Bank loan, it's 18,000. So you get an amount of 32,700. So assets minus liability, 137,620, minus the answer, you'll get an amount of 104,920. So the difference between the purchase consideration and the net asset acquired, that's now what we call the goodwill. And the goodwill amount of 5080. Goodwill, it's an amount of 5080. So the total is still 142,700. Good. So that's how you present that question. We can try another illustration. November 2015, question 3. November 2015, question 3. So November 2015, question 3, I told that Am and Bara are equal partners. When you talk about the equal partners, that means they are sharing profit and losses equally. Am and Bara are equal partners in a firm that buys and sells jewels. The financial year end of the business is 31st December. So the year ends on that 1st of December. On 1st April 2014, they converted the partnership into that of company, Ambara Limited. The trial balance as of that 1st December 2014 was as follows. So they converted their partnership on 1st of April 2014. So that means if the year ends on December, that means the financial year starts on January. And they converted on 1st of April. So that means January, February, March, they operated as partnership. So the partnership was for the first 3 months, and then the remaining 9 months, they operated as a company. The trial balance as of that 1st December 2014 was given as follows. So we have sales, purchases, discount allowed. We had bad debt, rent, salaries, distribution expenses, formation expenses, sundry expenses, capital, trade payables, furnitures and fittings, motor vehicles, inventory, 1st January 2014, that's the opening stock. Trade receivable, cash at bank, then we have the drawings. The partners have not made any changes to reflect the conversion of the partnership into a company. Number 2, sales and purchases accrued in the ratio of 20% and 80% for partnership and company respectively during the year. A discount allowed are to be apportioned in accordance with the sales. Other expenses accrued evenly unless otherwise stated. Number 4, all the bad debt were written off in the last 9 months of the year. Number 5, depreciation per annum is to be provided using reducing balance method as follows. So we have that depreciation. Then to that, including the motor vehicle balance in the trial balance is the purchase of a motor vehicle for 700,000 on 1st of May 2014. Number 6, inventory as at that 1st December 2014 was valued as 2825. That's the closing stock. And you see that whenever you're given the closing stock, you need to compute the cost of sales. That means you're not given the cost of sale. Cost of sale is opening stock plus purchases minus closing stock. And you are given the opening stock. Let's go to the trial balance. The opening stock we have is 25,000. You are the purchases. The purchase is the second item in the trial balance. We have 57. You raise closing stock, the one you're given in note number 6. Inventory as of that 1st December 2014 was valued at 2825. So that means how much was the cost of sales? So it's 25,000, you add 57,000, you minus 2825, and you'll get an amount of 61,175. Good. Number 7, Amu and Bara withdrew 600,000 and 1.3 respectively in the quarter ended that 1st of March 2014. They were entitled to direct a salary of 1.8 each per annum. The company issued 200,000 ordinary share of shillings 150 each in settlement of the purchase of the assets and liability of the partnership. Required income statement in a columnar format for the partnership and the company for the year ended that 1st December 2014. Then number B is a statement of financial position of the company. So first of all, let's compute depreciation. Let's go to note number 5. A depreciation per annum is to be provided using reducing balance method as follows. We're using reducing balance. So how do we get depreciation? Number 1, we have on furnitures and fittings. We have for the partnership, then we'll have for the company. And remember, we are using reducing balance. So what does it mean? So partnership, the rate is 10%. The company, the rate is 12%. And we are using reducing balance method. So how much was the value of furnitures and fittings? The value of furnitures and fittings was an amount of 2,400. But remember, the business was partnership for the first 3 months. So 10%, remember, is the rate per annum, but it's only operated as a partnership for the first 3 months. So you take 3 over 12, and what do you get? So in that case, you get an amount of 60. Then for the remaining 9 months, it operated as a company. So, and remember, using reducing balance. So the cost was 24. First of all, you deduct the depreciation for the first 3 months. 24. You less the accumulated depreciation at the date of conversion. And then once you get depreciation, also 12% is per annum. You restrict that for the remaining 9/12 months. So that is 60. So this one will be an amount of 210. We also compute for the motor vehicles. Motor vehicle will do the same for the partnership, then for the company. For the motor vehicles, for the partnership, the rate was 20%. For the company, the rate was 18%. How much was the value of the motor vehicle? The motor vehicle, the value was 2,800, but you need to deduct something. Now let's go back to note number 5, the last sentence. Included in the motor vehicle balance in the trial balance, this one of 28, in the trial balance is the purchase of a motor vehicle for 700,000 on 1st of May 2014. So this included an amount of motor vehicle which was purchased on from May. So that if it was purchased on May and you're using reducing balance method, you will depreciate that asset from May to December. For the partnership, it was between January to March. So that's why you have to deduct this so that you get depreciation per annum. Then you restrict 3/12. 3/12. You will get an amount of 105. For the company, you take 18%, 2,800 minus 700. So that means the original cost of the other asset was 21. That's the cost. Then you less depreciation for the first 3 months, which is 105. Remember using reducing balance. So it's 2,100. You minus accumulated depreciation of 105. Then 18% is per annum. You restrict for the 9 months, 9/12. And in that case, you'll get an amount of 269. 105. This one will get 269. Also, 18%. Remember, there is this new machine that we purchased on 1st of May. It's still part of motor vehicle. So you take 1,800. This asset was worth 700. Then was purchased from on 1st May. So you accumulate from you depreciate from May to December. How many months are those? Those are 8 months. 8/12. So what do you get? You get an amount of 84. So that means the depreciation charge for the company will be 353. For the company, we have that, and also we have for that new motor vehicle. So now let's present the income statement. We can present the income statement on a columnar format. So number 1, we have to present the income statement. And we have to present in a columnar format. So we have for the partnership. And it was partnership for the first 3 months. Then it was converted into a company. Then we prepare for the company for the last 9 months. So to the income statement, we start with the sales. How much was the sales? Sales was an amount of 77,025. Let's go to note number 2. Note number 2, I told that. Sales and purchases accrued in the ratio of 20 and 80 for the partnership and the company respectively during the year. For the partnership, 20%. For the company, 80%. So take 20% of 77,025. You'll get an amount of 15,405. Then 80% to the company, 61,620. Then you raise the cost of sales. Here was the cost of sale. The cost of sale, we have it 61,175. So we do the same, 20%, 80%, because purchases form the part of the cost of sales. So what do we get? So here you have an amount of 12,235. Here you have an amount of 48,940. And that's how we determine our gross profit. So gross profit here you have it's an amount of that 170. Here you have an amount of 12,680. Now let's deduct other expenses. And other expenses we have discount allowed. and discount allowed was an amount of 1,600. We are told that in note number 3, discount allowed is to be apportioned in accordance with sales. So that means 20 and 10. Then other expenses accrued evenly. When you talk about evenly, you use what you call the time apportioned. 3/12, 9/12, unless otherwise stated. So discount accrued the same the way as sales. So therefore, 20% of this will be an amount of 320, and then 80% of 1,600 will be an amount of 1,280. We also had bad debt. And bad debt, we are told in note number 4. All the bad debt were written off in the last 9 months of the year. For the last 9 months of the year, of which that time the bad debt was an amount of 800. That's for the company. Then we have rent. So rent is an amount of 1,800. You see, we are told that in note number 3, discount allowed is to be apportioned in accordance with sales. Other expenses accrued evenly unless otherwise stated. So for example, this one, we accrue evenly. That means you take 3/12 for the partnership, then for the company you take 9/12. Take 9/12. So you have 450. Here we'll have 1,350. Then below the rent, we have salaries. Salaries was an amount of 54 times 3/12, 9/12. So salaries will be an amount of 1,350. And then we have 40/50. Also, we had distribution expenses. Distribution expenses was an amount of 600. 600, that one will be 150. This one will be 450. Then we also have below distribution, we have formation, but you know that formation is for the company. Formation expenses, but formation expenses, that's for the company, an amount of 240. So do we have any other expense? After formation, we also have sundry expenses. Yeah, sundry expenses. How much was the sundry expenses? It was an amount of 950. Then your portion 9/12, 3/12, 9/12. This is 237.5, and this one is 712.5. Then you also have director salary. Let's go to note number 7. Note number 7. Amu and Bara withdrew 600 and 1.3 respectively in the quarter ended 31st of March 2014. They are entitled to director salary of 1.8 each per annum. 1.8. So now listen here. It's 1.8 each. How many partners were there? There were 2 partners. And then it's director salary. Director salary, that's a pure company expense. It's not for the partnership. You see, director salary, you don't have directors in partnership. Director is only for the company. So that means they're entitled for the 9 months. 1,800 is per annum. So you take 18 times 2, you get their total salary per annum. But it's only operated for only 9 months. So you restrict that 9/12. So 9/12 of that, that becomes 27. And that one is only for the company. And then also lastly we have depreciation. Depreciation number 1 we had for the furnitures and fittings. Here it is. For the partnership 60, for the company to 10. 60 to 10. Then we have on motor vehicles. Motor vehicles for the partnership is 105. And then for the company is 353. And that's how you determine the profit. That's how you get the profit. So here you get an amount of 497.5. Here you get an amount of 534.5. 534.5. Good. Now we can answer part B of the question. Part B was a statement of financial position for the company. So how do we prepare the statement of financial position? So they converted it into a company, that's Ambara Limited. Present statement of financial position. Statement of financial position as at 31st of December 2014. They took over all the assets, that's what we are told. So we start with the non-current assets. So you only had two non-current assets. One is the furnitures and fittings, then you also had motor vehicles. Furnitures and fixtures, the cost was 2,400. You raised depreciation for the partnership 60, then for the company 210. Motor vehicle, the total was 2,800, including the machinery that was purchased on May. You raised depreciation for the company, for the partnership, then you raised for the company an amount of 353. So how much is that? So this one will be 2130. Our shillings are in thousand. Then for the motor vehicles is 2342. Then we also have an element of goodwill. Yeah, remember, whenever we are converting, the difference between the purchase consideration and the net assets taken over gives rise to goodwill. So we come back to goodwill, go to the current assets. And the current assets, we are given the inventory. How much was it? Inventory, note number 6. Inventory as at that 1st December 2014 was valued at 2825. 2825. We go back to the trial balance. To the trial balance, we also had cash at bank. Cash at bank was an amount of 5635. Also, you have account receivable. How much is account receivable? Account receivable, it's an amount of 81. Then we also have drawings receivables. How do you get drawings receivable? This is how we get the drawings receivable. Now let's go to note number, let's go to the trial balance, the last item in the trial balance. We had drawings. Amu had drawings of 2,700 plus Bara 2,300 minus the drawings before the conversion. Let's go to note number 7. Amu and Bara withdrew 600 and 1,300 respectively in the quarter ended that 1st of March 2014. So withdrew 600 and 13. Now the total, that's the over drawings, it becomes receivable. In a company you cannot make the drawings, you can only make it in partnership. So that amount you expected to, the company expect to receive back from those partners. And therefore, how much will be that? That one will be an amount of 3,100. Go to equity and liabilities. Under the equity and liabilities, we have ordinary share capital. And the information about the ordinary share capital we are given in the last note, number 8. The company issued 200,000 ordinary share of 150 each in the settlement of the purchase of the assets and liability. Now that's what we call the purchase consideration, which was settled through the issue of shares. So that's an amount of that million, that thousand. Then you add retained earnings. Let's be here. The company for the last 9 months, remember the balance sheet we are preparing as at the end of the year. As at the end of the year, this one is a company already. And during the year, the company made a profit, an amount of 534.5. 534.5. So that one becomes the part of the retained earnings. Let's go to the liabilities. And liabilities, we have current liabilities. I haven't seen in non-current liability. We have trade payables. Yeah, that one we are given the trial balance. Trade payable, it's an amount of 93. Then, do you remember the director's salary? We never paid, we only provided. Can we go back to note number 7? Amu and Bara withdrew 600 and 1.3 respectively in the quarter ended that 1st of March 2014. They are entitled to director salary of 1.8 each per annum, of which we already provided the director salary. You see, it was never paid. We only made a provision of this 2.7. So therefore, we had accrued director salary. We have not yet paid, because if we had already paid, it could have been captured in the trial balance. So an amount of 27. So in that case, you'll get that the total equity and liabilities, it's so this the total amount is 42,534.5. Also here you get an amount of 42,534.5 when the goodwill balancing figure, when the goodwill or the balancing figure in that case we had was 42.5. And we said that how do we get the goodwill? Now this is how we get the goodwill. We say that you take the purchase consideration. And how much was the purchase consideration? How much was the purchase consideration? They were given 200 shares each at 150. So goodwill, you take the purchase consideration, which is an amount of 30,000. Then you raise net asset acquired. Now for the net asset acquired, in this case, we are given their partner's capital. If you're given the partner's capital, you can adjust that. Remember, assets minus liability to get the net asset. Also, it's equivalent to the equity part, the ordinary share capital, the retained earning, blah, blah. In short, the partner's claim. How do we get the partner's claim? Number one, we had the capital balance. Capital balance. Let's go to the trial balance. Amu and Bara. Amu, the capital balance, 18, the other one had 13. So in short, their total capital, they had contributed a total capital of 31. Then you add profit. Here is the profit. Before the conversion, the partners had made a profit of 497.5. Then you raise drawings. How do we get that? Okay, there, I gave you the formula on how to determine the capital balance carried down. Capital balance brought down. You add the profit, you raise the drawings. So here you raise the drawings for the partnership only. Let's go to the last note. That was note number 7. Amu and Bara withdrew 601.3. That's 1.9. So you take the capital balance for the two partners, you add profit for the partnership before conversion, then you raise the drawings to determine how much was their net assets or how much was their claim at the date of conversion. You get a total of 29,597.5. So the difference now between the purchase consideration and the net asset acquired, you will get an amount of 402.5. 402.5. So let's try another illustration. December 2021, question number 2. December 2021, question number 2. Yeah, so this one had an element of amalgamation as well as the conversion. So kindly, I need you to follow me, because in this case, somehow there is some, it's somehow complicated, somehow. I'm not saying it's complicated, it's somehow, so you better reason. So K and L were sole traders manufacturing solar equipment. So K and L, they were operated as sole proprietorship. On that 1st of October 2020, they amalgamated and traded as partners, sharing profit and losses in the ratio of 3:2. Then they amalgamated, they joined together to operate as partners, with profit and loss sharing ratio of 3:2 respectively. 1 year later, on that 1st October 2021, they converted the partnership into a limited liability company called Kiro Limited. So they operated as sole proprietors, they amalgamated, they operated as partners for 1 year. After 1 year, they converted the partnership into a limited company known as Kiro Limited. Good. No adjustment have been made to record the amalgamation and conversion, but the summary statement of financial position for the sole traders as of that 1st October 2020 and as the partnership as that 1st October 2021 are as follows. So they never recorded amalgamation. So for amalgamation, you just need to determine when they amalgamated, when they took over the asset, they took at a gain or a loss. So you need to revalue the assets. So we're given the sole trader statement of financial position as of that 1st October 2020. That was the date of amalgamation for K and L. Then we are given the partnership statement of financial position. That's after 1 year. That's the statement of financial position for the partnership is at the date of conversion. The one for K and L is at per the date of amalgamation. So we have all that assets, then we have liabilities. Then below the liabilities, now for example, can you look for K? Below liability, if you take asset minus liability, we have 28,400. Then for L is 22,600. Then for partnership is 57,400. What is that? So I want you to write something. Now that's what we call the net asset stroke capital. That's how we get capital. By the way, how do we get the capital? Capital is assets minus liability. So in short, you already given the capital balance brought down and the capital balance carried down. So those are the capital. Good. Let's go to the additional information. Number 1. On April 2020, now April 2020 was the date of amalgamation, the partners agreed to take up the assets and liability of the individual traders at book value, except for freehold property, plant and equipment, fixtures and fittings, which were revalued as follows, K and L. So let's determine whether we revalue it again or loss. So let me prepare for you the valuation account. And the valuation account in this case, we had 2 sole traders. We had 2 traders here. KL. Now in a revaluation account, remember revaluation is part of the equity. On the credit side, you factor in the revaluation gains. On the debit side, you factor in revaluation losses. Because if it's an asset, if it's gain, you debit, so you create the revaluation account. Now let's start with freehold property. We go back to the trial balance. Let's go to the trial balance. In a trial balance, for K, freehold property was 6,000. Then number 1, it was valued to 8,000. Was it valued at a gain or loss? That's a gain. Freehold property. That's a gain of 2,000 from 6,000 to 8,000. What about for L? For L, freehold property in the trial balance was an amount of 4,000. Then in note number 1, it was taken over at 6,000. 4 to 6, that means also there is a revaluation gain of 2,000. Plant and equipment. Let's go to the trial balance. Plant and equipment. For K, plant and equipment was an amount of 27,200. Then it was taken over at 26. That's a revaluation loss. Plant and equipment. There's a loss of how much? That's from 27,200 to 26. That's a loss of 1,200. What about for L? L, plant and equipment was 22,400. They took over at 22. Also, it's another loss. A loss of how much? A loss of 400. That's a loss of 400. What about furnitures and fixtures? K, it was 64. Was taken over at 6. So there is a loss of 4. That's for fixtures and fittings. What about for L? L, fixtures and fittings was 6,200, was taken over at 6,000. So there is a loss of 2. So do we have a net gain or loss? Do we have a net gain or loss? So that's a gain. Because if you have to balance this is 2,000, this is 2,000. 2,000, 2,000. 2,000 minus 16, so there is a gain of 4. 2 minus 8, there is a gain of 12. 4 and 12. So 12 or 14, sorry, 4, 5, 6, this should be 14. Yeah, 4 and 14, good. So that was the revaluation gain at the date of amalgamation. Number two, during the year ended that 1st October 2021, that's at the date of conversion, K made drawings of 9560 while L withdrew 2440. Those are drawings. Number 3, the partners was converted into a limited liability company on the following terms. So this is on conversion. Freehold property and account receivable are revalued at 24 and 22,600 respectively. Those are revaluation on conversion. This was revaluation on amalgamation. So revaluation on conversion. Now this one was after 1 year. How was it? Let's go read number 3, bullet 1. The freehold property and account receivable were revalued to 24. Freehold property was revalued to 24. Receivables was revalued to 22,680. You compare that against the balance brought down. So let's go back to the trial balance. Now trial balance for the freehold property, remember this was on conversion. So therefore you take the freehold property of the partnership. Freehold property of the partnership was an amount of 16. So that means there was a revaluation gain. From 16 to 24, there was a revaluation gain by 8. From 16 to 24. What about receivable? Receivable was an amount of 25,680. Yeah, you are looking the one for the partnership because this is revaluation on conversion. So receivable was an amount of 25,680, then was revalued to 22,680. So there is a loss of 3,000. So therefore there is a net of how much? A net gain of 5,000. And remember this one being a gain and loss. How are the partners sharing? Remember this was partnership. This was revaluation as per the sole proprietorship. So this one will go to K, this one will go to L. The total of 5,000 they'll share among the partners in their profit and loss sharing ratio. Good, we'll come to that. Number 3, part 2. Number 3, part 2. K and L were to receive 15% unsecured debentures at par so as to provide each partner with income equivalent to 6% return on capital employed based on the capital balances as at that 1st October 2021. That is after accounting for the profit, drawings, and revaluation in bullet 1 above. Number 2, Kilo Limited authorized share capital was made up of 600,000 ordinary shares of shillings 50 each, out of which 520 shares were to be issued to the partners in their profit and profit sharing ratio. Issue of shares. How are they given shares? We are told that Kilo Limited authorized share capital was made up of 600 ordinary shares of shillings 50 each, out of which 520 shares were to be issued to the partners. So the partners, they were given 520 shares each at 50. So that means 520 multiplied by 50, you get an amount of 26 million. Then how was this shared or how was this distributed? We are told that which were to be issued to partners in their profit sharing ratio. How much was the profit sharing ratio? There were partners sharing profit in 3:2. 3:2. So therefore it will be 3/5, 2/5, 26,000, 26,000. Yeah, it was 3:2. Sorry, 3:2. So therefore you multiply by 3/5. So this one will be 15,600. 26 minus the answer, you get 10,400. That's how I issued the shares, or how the shares were issued to the partners. The last bullet of note number 3. Any balances in the partner's capital account were to be settled in cash. Required a computation showing the value of debenture and ordinary share to be issued to partners. A computation showing the value of debenture. So now let's go back to note number 3. I want us to read number 3 again. The partners was converted into a limited company on the following terms. We have gone through number 1, that was revaluation. Number 2, K and L were to receive 15% unsecured debenture at par, so as to provide each partner with income equivalent to 6% return on capital employed based on the capital balance on that 1st October 2021. That is after accounting for profit. Can you add profit? Drawings and revaluation. So already given drawings, we already given revaluation, but we're not given the profit. So that means after amalgamation, up to the date of conversion, that's after 1 year. So that during the year, that during one financial year, they either made a profit or loss. So how do we determine the profit or loss they made during that period? Because that one will affect the capital balance. So we want to determine the profit. Determining profit for partnership business. They are not given that profit. Now, how do we get profit? Now, to get the profit, let me give you the easier formula. How do we get the capital balance carried down? To get the capital balance carried down, you take the capital balance brought down, you add the profit, you raise drawings. Capital balance brought down, you add the profit, you raise drawing. But in this case, we also have to add revaluation because there was some revaluations. Minus drawings. That's how you get the capital balance carried down. But what we need here is the profit. So can you be able to make the profit the subject? Therefore, to get the profit, you take all this to the other side. You'll take the capital balance carried down. Drawings, if you take it to the other side, becomes positive. You add drawings. You minus the capital balance brought down. Capital balance brought down. You also deduct revaluation. And so now let's do that. So we start with capital balance carried down. Now note this. In the first thing, there is something I told you to write on. The capital. You see, we are given the assets and the liability. Asset minus liability. What we have is the net asset of the capital. Now, the balance carried down is the one we have at the date of conversion. That's for the partnership. How much is for the partnership? For the partnership, the balance carried down, we have it's an amount of 57,400. You take balance carried down, then you add drawings. How much was the drawings? So you're already given the drawings. Let's go to note number 2. During the year ended that 1st October 2021, K made drawings of 9516, while L withdrew 2440. Withdrew 2440. So how much is the total? So the total drawings we have is 12,000. Then you raise capital balance brought down. Now, for the capital balance brought down, you see before it was a partnership, it was a sole proprietorship. So how much they contributed? So we have for K and we have for L. Those are the capital balance brought down. K, the capital was 28,400. L was 22,600. So that means how much was the capital balance brought down? That was an amount of 51,000. Then you also raise revaluation. Now note that revaluation in this case, you only take the revaluation on amalgamation. The revaluation on conversion was at the date of conversion. So in this case, we want the capital of these two partners at the beginning of the period, of which year we had revaluation gain. K and L, 4 and 14. 4 and 14. So at that time, we had already a revaluation gain an amount of 1,800. 1,800. So how much was the profit then? How much was the profit? And the profit is 16,600. We have used this formula. To get the profit, to take the capital balance carried down, you add drawings, you raise capital balance brought down, you also raise revaluation. That was the profit. How are they sharing? They were sharing in the ratio of 3:2. So profit share K and L. 3 over 5, 2 over 5, 16,600, 16,600. So that means each had a share of how much? So this one is 99.60. This one is an amount of 66.40. 66.40. So now with that, we can be able to adjust. So now we are answering this question, part 1. A computation showing the value of debenture and ordinary share to be issued to the partners. So already have the value of shares, that one you have answered. So you want to determine the value of debentures. Now, to determine the value of debentures, remember they were given debenture on the date of conversion to partners. So first of all, you have to determine the adjusted capital. Determining adjusted capital for debenture issue. Because you see, each partner was given different value of debenture. We have K, we have L. We want to determine the adjusted capital. And how do we get the capital? We have said that to get the capital is a balance brought down, capital balance brought down. You add the profit, you add the revaluation, you raise the drawing. So you start with capital, balance brought down. How much was for K? K, the first page. We have for K and we have for L. Those are the balance brought down. For K, we had 28,400. L, we had 22,600. Then you add profit. We have computed the profit here. The profit share we had 99.60. Then we have 66.40. Then you also add revaluation. Now in this case, now you take the total revaluation, the one on amalgamation, also the one on conversion. On amalgamation, K made a gain of 400, the one made a gain of 1,400. Then on conversion, here was the revaluation gain on conversion, 5,000. But remember on the partners, how are they sharing any gain or loss? They were sharing in the ratio of 3:1. So we need to apportion this. 3 over 5, 2 over 5 times that 5,000. That is 3,000. This is 2,000. You see, this was the revaluation on conversion. Already the partnership was their business, and they were sharing any gain or loss in the ratio of 3:2. This was the revaluation for specific partner or for specific sole proprietor. That's why I had 4 and 14. This one was for the partnership, and for the partnership, any gain or loss, they are sharing in the ratio of 3:2. So on conversion, here you'll add 3,000, here you'll add 2,000. Capital balance, you add profit, you add revaluation, then you raise drawings. You raise drawings. K made a drawings of how much? Yeah, that's note number 2. K had made a drawings of 95.60. That had made 24.40. That one were given in note number 2. So how much was the adjusted capital? So adjusted capital here will have an amount of that 2,200. You have an amount of 3,200. So now we determine the debenture issue. Let's read the fourth time. Let's read the fourth time. Number 3, that bullet. Number 3, now the second bullet. K and L were to receive 15% unsecured debenture. So that means they'll be getting a debenture which will be earning an interest of 15%. 15% debenture at par, so as to provide each partner with income. You see that 15% is the income, which will provide each partner with income equivalent to 6% return on capital employed. 6% return on capital employed. 6% return on capital. Return on capital employed. Now this is the adjusted capital. So 6% of that 2,200, then you do the same 6% of that 200. So this one will be an amount of 1932, and this one will be an amount of 18 12. Now let's read that statement again. Number 3, bullet 2. K and L were to receive 15% unsecured debentures so as to provide each partner with income equivalent to 6% per annum on return of capital employed based on the capital balances as at that 1st of October 2021. You see this 6% on capital employed, this one. Now they were to get debenture which will be yielding the same return, but that debenture will be 15%. So therefore, how much will be the value of the debenture? How much will be the value of the debenture? Therefore, to get 15% debenture, you'll do this. You'll take 1932, you divide by 0.15. What about this? 1812, you divide by 0.15. So how much will be that? So this one will be an amount of 12,880. This one will be an amount of 12,080. That's the 15% debenture issue. Okay, now this is what I want you to ascertain whether you have done the right thing. If you take 15% of 12,880, how much is that? 15% of 12,880. Will it give you 1932? Yeah, that's what we mean. That they were issued with 15% debenture, which will be equivalent to 6% return on the capital employed. Now, if you take 15% of 12,080, 15% of 12,080, will you get a return of 1812? Will you get a return of 1812? So, that was the issue of debenture. Number B of the question. Number B of the question. Partners capital account. That's always the easier one. Part B. Partners capital account. So how do we prepare the partners capital account? So partners capital account always carries free marks. Even if you don't remember what you are doing, just record the balances brought down on the current account. That will be all. So we had two partners, K, L. K, L. So how do we prepare the partners capital account? You start by recognizing the capital balance brought down. Here they are. Actually, this one here. Capital balance brought down for K was an amount of 28,400. For L was an amount of 22,600. Then they also had revaluation gain. Revaluation gain. One was on amalgamation. On amalgamation, we had 400. Here we had 1,400. Also, there was a revaluation gain on conversion. Revaluation gain on conversion, K 3,000, 2,000. Also, the profit increases their claim. There is profit. Profit share, K 9960, 6640. Then drawings reduces their claim. Drawings. Made a drawings of 9560. This one had made 2440. Now, if you take those, the credit side, you minus this, you'll get this adjusted capital. This means this was their claim at the date of conversion. How was that claim paid? Now, that claim was paid into two, actually in three aspects. Number one, they were given shares. They were given ordinary shares. Here it is. Issue of shares. 520, each at 50, which is 26. How was it allotted? K was given shares worth 15,600. That's by the company. The purchase as part of purchase consideration. And the other one got 10,400. Apart from share, they also are given 15% debenture. There was issue of debenture, this 15% debenture, of which K was entitled to 12,880, and this one was an amount of 12,080. So how much is this? So this one is an amount of 41,760, and that 2,640. Also here you balance that, 41,760, that 2,640. Now if you take this, you minus the claim, how much is the balancing figure? So you get the balancing figure. Now the balancing figure, if you take for example 41,760, you minus 9560, 15,600, 12,880, you'll get an amount of that 720. You'll get an amount of 7720. Now what is that? Because we see that partners capital account should always balance, because we are closing off the books, should balance. There should be no balancing figure. Now that balancing figure, let's go to note number 3. And note number 3, the last bullet. Note number 3, the last bullet. Any balances in the partner's capital account were settled in cash. Any balance, it was settled by cash. You see, this is the claim. The partners, they were to be paid. It's not the partner they are paying to the company, it's the company who will pay the partners. So that means K will get an amount of that 720,000, 7720,000. So that's how you prepare the partner's capital account. Lastly, part C. Part C, we are to prepare the statement of financial position of Kilo Limited after completing the above transactions. So how do you present statement of financial position? So I need to rub one. So what one, which one would I rub? So let me just rub this. Or let me just rub this. Part C, prepare the partner's capital account. Sorry, I mean the statement of financial position. It was converted to Kilo Limited. Present statement of financial position as at 31st October 2021. So our sharings are in thousands. So we start with the non-current assets. For the non-current assets, we have freehold property. And in this case, remember, we are converting the partnership. So you take the assets in the partnership column, not for the sole proprietorship K and L, for the partnership. Then for the freehold property, we are given in note number 1. You take the revalued amount. Freehold property was revalued at 24. Then we have plant and equipment. Plant and equipment in the partners column is how much? It's an amount of 52. Then you have fixtures and fittings. Fixtures and fittings, it's an amount of 12. Then we go to the current assets. Under the current assets, we have inventory. Inventory in the partners column is an amount of 13,400. Also, we have receivable. Now, receivable in note number 1. Freehold property and account receivable on conversion, they were revalued. So for the receivable, you take the revalued amount, which is 22,680. So you get total assets. For the total assets, you'll get an amount of 124,080. Then we go to equity and liability. So under equity and liabilities, number 1, we have ordinary share capital. Remember, I issued through they were issued shares. 15,600, 10,400, which was 26,000. 26,000. So that's 15,600. And then you add 10,400. Then we go to the non-current liability. And on non-current liability, the company also issued 15% debentures. 15% debentures. For 15% debentures, here it is, K 12,880, and then we have 12,080. That will be an amount of 24,960. And then we go to the current liability. Now, current liability, you take the one we have in a trial balance. We have account payables. Account payables for the partners column, we have is that 9,680. Then we have bank OD, overdraft. How do you determine bank overdraft? So now listen here. This is how we get bank overdraft. Now, how much was the bank balance as per the trial balance? Under the current asset, we had bank balance. Bank balance brought down. In the part of the current assets, we had an amount of 500. Then, under the liabilities, we also have the bank overdraft. How much is it? We have an amount of 22,500. This was the bank as per insured cash and bank balance. Then there was bank overdraft 22,500. Then remember you told that in the partners capital account, the balance, the partners were settled in cash. So that means the company paid the partners this amount in cash. That means it was an outflow, it was not an outflow. So payment as capital. Payment as capital. Kilo, that's 720, and then L, 7720. So the total will be an amount of how much? So the total will be 3720. You add 7720 to get an amount of 11,440. So how much will be adjusted amount of bank OD? So for the adjusted amount of bank OD, an amount of 33,440. 33,440. So therefore, our bank overdraft is 33,440. Good. That's how you're supposed to present that question. And actually, this question was just a copy pasting of question for November 2020. So you can go and try that question if you have time. If you have time, you can go and try that. It's the same question. That was for November, not November, but December 2020. Yeah, question 4. November 2020, question 4. Yeah. November 2020, question 4 is a replica of this question. So, and that marks the end of partnership blocks revision. So, thank you for your time.